Welcome to The Explainer. Today, we're diving into a company that's trying to completely flip the script on how humanity builds for space. We're talking about York Space Systems, or YSS. Founded back in 2012 in Denver, these guys aren't just trying to build a slightly better satellite. No, they're out to literally rewrite the entire manufacturing playbook for the aerospace industry.
It's a huge challenge, right? I mean, for decades, satellites have been built kind of like bespoke luxury cars. They're handcrafted, super customized, astronomically expensive, and just agonizingly slow to put together. But what happens when you suddenly need thousands of satellites for these new low Earth orbit constellations? You just can't rely on those artisanal methods anymore. So the big question is, how does a company actually transition from that slow traditional build process to a true high-speed assembly line in orbit?
Okay, let's dive into this. Here's our agenda for today. 1. Revolutionizing orbital manufacturing. 2. The extreme standardization edge. 3. Defense contracts and backlog. 4. Aggressive vertical integration. And finally, 5. Financial realities and risks.
Starting with Section 1, Revolutionizing Orbital Manufacturing.
To really get what YSS is doing, you have to understand the massive bottleneck they're trying to solve. Think about the stark contrast in the industry right now. On one hand, you have traditional primes spending literally years building a single complex satellite. YSS, they're bringing the Industrial Revolution to space. They're implementing a true mass production infrastructure geared specifically for low Earth orbit. Shifting from artisanal one-off builds to a mass production model, that is their entire foundational edge. And get this, they're aiming to produce over 1,000 satellites annually. Just let that scale sink in for a second. Over 1,000 a year. They're targeting a capacity that lets them manufacture, test, and ship thousands of spacecraft every single year. And because they're doing this at such massive scale, they can pump out these systems at a fraction of the cost of their traditional competitors. But, to crank out 1,000 satellites a year, you can't just tell your team to work faster. You have to work entirely differently.
Which brings us to Section 2, the extreme standardization edge.
Now, what's really interesting here is how they pull off this high-speed manufacturing. It all comes down to extreme standardization. Think about the sheer volume of shared parts. We're talking about roughly 75% of physical hardware and an absolutely wild 95% of software being shared across all their different platform classes. They're completely eliminating the need to reinvent the wheel every time. It's basically plug-and-play aerospace engineering. And that is exactly how they drive down costs and speed up their factory lines so dramatically.
So what do these standardized platforms actually look like in practice? Well, the lineup is highly scalable. You start with the S-Class. This is a nimble system for 85 to 200 kilogram payloads, built for really rapid deployment. Then you step up to the LX class. This one can handle double the payload of the S-Class, but get this, it still shares over 90% of its tech with the smaller version. Finally, you've got the heavy-duty M-Class. That one can carry massive 2,000 kilogram payloads for complex stuff like Earth observation and communications. They serve totally different missions, but under the hood, they share that exact same standardized DNA.
Moving right along to Section 3, Defense Contracts and Backlog.
Now, it is one thing to pitch a big vision, but YSS is actually deploying this tech in the real world, and they're riding some massive defense tailwinds right now. They're a primary supplier for the U.S. Space Development Agency's Transport Layer. If you're not familiar, that's essentially a giant interconnected data network floating in space. The Department of Defense is demanding these resilient, large-scale satellite constellations, and YSS's mass production model fits that need perfectly.
To get into the specifics, they're a key partner for the SDA's Tranche 0 and Tranche 1 projects, which are the foundational rollouts for this huge new network. They also bagged a whopping $200 million contract under the T1DES program just to build 12 prototype satellites. And beyond the SDA, they're serving the broader U.S. Space Force and various commercial sectors too. I mean, this represents a very, very deep level of trust from the federal government.
And all that trust translates directly into this number, a $543 million secured backlog as of the fourth quarter of 2025. That represents 107 satellites that are already under contract. Why should we care about that? Well, in the aerospace sector, which can be notoriously volatile, having a backlog of over $500 million gives you incredibly strong mid to long-term revenue visibility. It literally proves the demand is there.
Let's move to Section 4, Aggressive Vertical Integration.
Okay, let's see how this builds out. To pump out all these satellites and actually make money doing it, YSS realized pretty quickly they couldn't just rely on outside vendors. They needed to own the process. Take a look at this incredibly rapid timeline of acquisitions. In 2023, they bought Emergent Space Technologies to bring flight software in-house. Then, jump to August 2025, they scooped up Atlas Space Operations to control their global ground networks. And just recently, in March 2026, they bought Orbion Space Technology to internalize propulsion systems. They are systematically buying up every piece of the puzzle they need to control the entire life cycle of a satellite.
This vertical value chain integration is an absolute game changer for them. By bringing design, software, ground operations, and propulsion entirely in-house, they drastically cut down on outsourcing costs. But even better, it paves the way for them to offer what's called software-enabled services. Basically, they can sell a fully integrated turnkey solution to their customers, and that has the potential to be a highly profitable business model.
And finally, Section 5, Financial Realities and Risks. All right, time to pivot from the high-flying tech roadmap down to the cold, hard reality of the public markets. We'll start with the good news, and honestly, it's incredibly strong. USS posted a 52.3% year-over-year revenue growth rate, with their annual revenue hitting $386.2 million in 2025. Driven by those massive defense contracts we just talked about, their top-line expansion is undeniably explosive.
But you have to immediately contrast that incredible growth with this pretty sobering metric, minus 68%. That is roughly how far their stock plummeted from its post-IPO peak by August of 2026. Following an earnings miss in the second quarter of 2026, the stock just took a massive hit. It's a really stark reminder of the extreme volatility you see in the public space sector. Let me play financial translator for a second here. In Q2 of 2026, they pulled in a very impressive $92.55 million in revenue. However, their net income for that exact same quarter was a negative $39.34 million. And if we look back slightly to Q4 of 2025, their free cash flow was negative $37.6 million. So what's the big takeaway? Despite massive, explosive revenue growth, the company is still operating at a pretty significant loss, and they're burning through cash to scale up their operations. When we check under the hood at the balance sheet to see if they can actually survive this cash burn, it's definitely a mix of strengths and risks. On the plus side, they're sitting on roughly $534 million in cash and equivalents. That gives them plenty of short-term liquidity. But on the flip side, they're also carrying $177.3 million in total debt. So they absolutely have a runway, but they desperately need to hit profitability before that runway runs out.
So the crucial point here is understanding the very real threats that are keeping them in the red. A massive issue for them right now is margin pressure. You see, YSS relies heavily on fixed-price contracts with the government. Now, during times of high inflation or when supply chains get snarled, if it costs YSS more to build a satellite than they originally projected, well, they have to eat that cost. They can't just pass it along to the government. Because of this dynamic, market analysts have actually pushed back their target for break-even profitability. They originally hoped for 2027, but now that's been delayed all the way to 2028, and that creates a huge valuation burden.
Which leaves us with this final, really fascinating question. York Space Systems has undeniably built an industry-leading mass production infrastructure, and they clearly have the multi-million-dollar defense backlog to prove their tech actually works. But can YSS outpace the very real margin pressures of their fixed-price contracts to finally hit that 2028 profitability target? Or will the sheer gravity of the public markets and this ongoing cash deficit keep the stock grounded? It is such an interesting tension between this incredible orbital manufacturing revolution and cold, hard financial reality. Thank you so much for joining me for this explainer. Keep learning, and I'll catch you next time.